I remember sitting in my office on a Sunday night in September 2008. The phones wouldn't stop ringing. Lehman Brothers had just collapsed. AIG was on the brink. The entire financial system was melting down, and everyone was asking the same question: will we survive this? But here's what struck me that night. While the world was panicking, while CEOs were scrambling, while politicians were debating bailouts, I was thinking about something else. I was thinking about the millions of Americans whose retirement savings were evaporating right before their eyes, people who had worked 30, 40 years, done everything right, now watch their 401ks cut in half. That night changed everything for me. Not just how I run JP Morgan Chase, but how I think about what people really need for retirement. Because here's the truth. Most people are preparing for retirement completely wrong. They're making the same mistakes over and over. They're chasing yield in the wrong places. They're taking too much risk or not enough risk. They're not thinking about longevity, about inflation, about what happens when the next crisis hits. And it will hit. Trust me on that. I've spent over 40 years in banking. Started as a management trainee, worked my way up through every crisis you can imagine. The savings and loan crisis of the 80s, the long-term capital management collapse in 98, the tech bubble burst in 2000, the financial crisis in 2008, the pandemic in 2020. And you know what I've learned? Every crisis is different, but the principles of surviving them are exactly the same. Today, I want to tell you about 4 assets, not 5, not 10, 4. These are the 4 assets you absolutely must own for retirement. Not should own, must own. Because without them, you're vulnerable, you're exposed, you're one crisis away from disaster. And let me be clear about something. I run the largest bank in America. We manage trillions of dollars. We have some of the smartest people in finance working for us, and this is what we recommend to our wealthiest clients. This is what the ultra high net worth individuals do. This is what works. So let's start with the first asset, the foundation. The thing that most people completely ignore until it's too late. Asset #1, FDIC insured savings and short-term treasuries. Now, I know what you're thinking. Jamie, that's boring, that's safe. That's for people who don't understand investing. And you're right, it is boring, it is safe. But let me tell you something I learned during the financial crisis. When everything goes to hell, when markets are crashing, when banks are failing, when people are losing their jobs, there is only one thing that matters: liquidity, cash, money you can access immediately without having to sell anything at a loss. I watched people during 2008 who had millions invested in real estate, in stocks, in complicated financial products, and when they needed cash, when they had an emergency, when they lost their job, they had to sell at the absolute worst possible time. They locked in their losses. They never recovered. But the people who had cash, they survived, more than survived. They thrived because they could wait, they could hold on, they didn't have to panic sell. Here's my rule. You need at least 1 year of living expenses in cash or cash equivalents. Not 3 months, not 6 months, 1 full year. And if you're over 60, make it 18 months to 2 years. Now, where do you keep this cash? FDIC insured savings accounts and short-term treasury bills. That's it. Not money market funds, not certificates of deposit with penalties for early withdrawal. FDIC insured accounts up to $250,000 per depositor per institution, and short-term treasuries with maturities of 3 to 6 months. Why treasuries? Because they're backed by the full faith and credit of the U.S. government. They're as safe as it gets. And in a crisis, when everything else is falling, treasuries go up. They're your insurance policy. Let me tell you what happened at JP Morgan during the financial crisis. We had built up enormous cash reserves in 2007. Everyone thought we were crazy. They said we were being too conservative. But when 2008 hit, that cash saved us. It let us acquire Bear Stearns. It let us stay strong when others were weak. It gave us options when everyone else had none. That's what cash does. It gives you options. It gives you power. It gives you the ability to not panic. Now, I know what you're thinking, but Jamie, interest rates are low. I'm not making any return on cash. And you're right, you're not. But that's not the point. This isn't about maximizing returns. This is about minimizing risk. This is about making sure you can sleep at night, knowing that no matter what happens, you've got a cushion. Think of it this way. Your cash reserve is like the foundation of a house. Nobody admires a foundation. Nobody takes pictures of it. But without it, the whole house collapses. That's what cash is, your foundation. So here's what I recommend. Take 1 year of your living expenses. Let's say that's $60,000. Put that in FDIC insured savings accounts and short-term treasuries. Split it between 2 or 3 different banks to maximize FDIC coverage. Keep it simple, keep it safe, keep it accessible, and never ever touch it unless it's a true emergency. Not for a vacation, not for a new car, only for real emergencies, job loss, medical crisis, market crash. That's asset number one, your foundation, your safety net, your insurance policy. But here's the thing, cash alone isn't enough because while cash protects you from crisis, it doesn't protect you from something even more dangerous, something that silently destroys wealth every single day, inflation. And that brings me to asset number two, asset tattoo, dividend-paying stocks. You know, there's a myth in investing that when you retire, you should get conservative. You should move out of stocks and into bonds. You should play it safe. And that myth has destroyed more retirement plans than any market crash ever could. Here's the reality. If you retire at 65, you might live another 30 years, maybe more. That's 3 decades. That's longer than most people's entire careers. And over those 30 years, inflation is going to cut your purchasing power in half, maybe more. What costs $100 today will cost $180 in 20 years at just 3% inflation. What costs $100 today will cost $240 in 30 years. So if all your money is in bonds and cash, you're getting poorer every single year. You're watching your wealth erode in real terms, even though the numbers in your account look the same. That's why you need stocks, not just any stocks. Dividend-paying stocks from high-quality companies. Now, let me tell you why I love dividend stocks for retirees. 3 reasons. First, income. These companies pay you cash every quarter, real money that hits your account, money you can spend without having to sell anything. And the best dividend stocks increase their payouts every year. So your income grows over time, keeping pace with inflation. Second, stability. Companies that pay consistent dividends tend to be mature, profitable businesses with strong balance sheets. They're not speculative growth stocks that could go to zero. They're established companies with real earnings and real cash flow. Third, forced discipline. When a company pays a dividend, management can't waste that cash on stupid acquisitions or executive bonuses. They have to give it back to shareholders. That creates accountability. That creates value. At JP Morgan Chase, we pay a dividend and we've increased it every year for decades. Why? Because it shows confidence. It shows we're generating real cash. It shows we're committed to shareholders. And in tough times, that dividend becomes even more important because it gives investors a reason to hold on. Now, which dividend stock should you own? I'm going to give you a framework, not specific names, because things change. But here's what I look for. First, dividend history. Has the company paid and increased its dividend for at least 10 years, preferably 20 or 25? That shows consistency. That shows management is committed to shareholders. Second, payout ratio. This is the percentage of earnings paid out as dividends. You want it between 40% and 60%. Lower than 40% means they're being too stingy. Higher than 60% means they might not be able to sustain it. Third, free cash flow. Does the company actually generate enough cash to pay the dividend? Some companies borrow money to pay dividends. That's a red flag. You want companies with strong free cash flow. Fourth, competitive advantage. Does this company have a moat? Something that protects it from competition? A strong brand, network effects, regulatory barriers, something that makes it hard for competitors to take market share. And fifth, balance sheet strength. How much debt does the company have? Can it handle a recession? Can it survive a crisis? You want companies with manageable debt levels and plenty of liquidity. Now, here's how I think about allocation. For most retirees, I'd recommend having 40% to 50% of your portfolio in dividend-paying stocks. Not 100%, not 10%, about half. And within that allocation, diversify across sectors. You want some financials, some consumer staples, some healthcare, some industrials, some utilities. Don't put all your eggs in one basket. Let me give you an example from my own experience. During the financial crisis, dividend stocks got crushed along with everything else. But here's what happened. The best companies, the ones with strong balance sheets and real cash flow, they kept paying their dividends. They kept generating income for their shareholders. And when the recovery came, those stocks didn't just recover, they soared. Because investors realized these companies had staying power. They had survived the worst financial crisis since the Great Depression. They were stronger than ever. The people who sold their dividend stocks in 2008 and 2009, they locked in their losses and missed the recovery. But the people who held on, who collected their dividends through the crisis, who stayed patient, they came out ahead, way ahead. That's the power of dividend stocks. They give you income, they give you growth, they give you a reason to stay invested when times are tough. But here's what's critical. You can't just buy dividend stocks and forget about them. You need to monitor them. You need to make sure the fundamentals haven't changed. If a company cuts its dividend, that's usually a sign something is seriously wrong. You need to investigate and potentially sell. At JP Morgan, we have entire teams of analysts who do nothing but analyze dividend stocks. They look at cash flow, they model scenarios, they assess risk, and even with all that analysis, we still get it wrong sometimes. But the process matters, the discipline matters. So here's my recommendation. Build a diversified portfolio of 15 to 20 high-quality dividend-paying stocks. Reinvest the dividends during your working years to compound your wealth. And then when you retire, switch to taking the dividends as cash income. At a 3% to 4% dividend yield, that's $15,000 to $20,000 per year on a $500,000 portfolio. Real money, real income, money that grows over time as companies increase their dividends. That's asset number 2. Dividend-paying stocks, your inflation protection, your income generator, your long-term growth engine. But there's a problem. Stocks are volatile. They go up and down, sometimes way down. And if you're retired and living off your portfolio, volatility is your enemy. You can't afford to sell stocks during a crash to pay your bills. That's why you need asset number 3, the shock absorber, the stabilizer. Asset up T3, investment grade bonds. Let me tell you about something that kept me up at night during the financial crisis. It wasn't the stock market crashing. It wasn't Lehman Brothers failing. It wasn't the bailouts or the congressional hearings. It was the bond market freezing. See, most people don't understand how critical the bond market is. The stock market gets all the attention, all the headlines, but the bond market is 3 times bigger. It's where companies borrow money to grow, where governments finance deficits, where the real economy gets funded. And in September 2008, it stopped working. Companies couldn't borrow. Governments couldn't roll over debt. Everything seized up. And that's when I realized bonds aren't just about returns. They're about the plumbing of the financial system. Now, here's why bonds matter for retirement. They do 2 things that stocks can't do. First, they provide stability. When stocks are down 30%, high-quality bonds usually hold their value or even go up. Second, they provide income. They pay you interest like clockwork, regardless of what the stock market is doing. But not all bonds are created equal. You need to be smart about which bonds you own. For retirement, I recommend investment-grade corporate bonds and U.S. Treasury bonds with maturities of 3 to 7 years. Not junk bonds, not long-term bonds, not emerging market bonds. Keep it simple, keep it high quality. Why investment grade? Because these are bonds from financially strong companies with low default risk. They're rated BBB or higher by the rating agencies. They're not going to blow up on you. Why 3 to 7 years? Because that's the sweet spot. Shorter-term bonds don't pay enough interest. Longer-term bonds are too sensitive to interest rate changes. 3 to 7 years gives you decent yield without too much interest rate risk. Now, here's how bonds work in your portfolio. Think of them as ballast on a ship. When the stock market is stormy, when waves are crashing, the ballast keeps the ship stable. Bonds do the same thing. They smooth out the volatility. They keep your portfolio from getting tossed around. But there's something else bonds do that's even more important. They give you dry powder. They give you money to spend during stock market crashes without having to sell stocks at the bottom. Here's the strategy. You keep 3 to 5 years of living expenses in bonds. Let's say you need $60,000 per year. You keep $180,000 to $300,000 in bonds. And when the stock market crashes, when stocks are down 30% or 40%, you don't sell stocks. You tap your bonds. You spend from your bond allocation. This gives your stocks time to recover. You're not forced to sell at the bottom. You can wait out the storm. And when stocks recover, when they're back to normal, you sell some stocks and replenish your bond allocation. This is called time segmentation or bucketing. And it's one of the most effective strategies for managing retirement portfolios because it removes the emotional decision-making. You're not panicking. You're not guessing. You're just following the system. Let me give you an example. In 2008, stocks fell 37%, but high-quality bonds were up 5%. So if you had a balanced portfolio, you were down maybe 16%. Still painful, but not devastating. And more importantly, you could sell some of your bonds to cover your living expenses while waiting for stocks to recover. The people who are 100% in stocks, they got crushed, down 37%, And if they needed money, they had to sell at the bottom. They never recovered. The people who had bonds, they survived. They had options. They could wait. Now let's talk about interest rates, because this is where most people get confused. When interest rates go up, bond prices go down. That's just math. So in a rising rate environment, bonds can lose value. But here's what you need to understand. If you hold bonds to maturity, you get your principal back. The price fluctuations don't matter. You're getting your interest payments along the way. And at maturity, you get your money back. So don't panic about interest rate risk. If you're holding high quality bonds with reasonable maturities, just hold them, collect your interest, and when they mature, reinvest at the new higher rates. At JP Morgan, we manage tens of billions in bond portfolios for our clients. And the strategy is always the same: high quality, reasonable maturities, diversification across issuers, discipline. We're not trying to hit home runs with bonds. We're trying to preserve capital and generate income. That's it. Boring, but effective. So here's my recommendation for bonds. Allocate 30% to 40% of your portfolio to investment-grade bonds with maturities of 3 to 7 years. Split it between U.S. Treasuries and high-quality corporate bonds. Maybe 60% Treasuries, 40% corporates. And use low-cost bond funds or ETFs. You don't need to buy individual bonds unless you have a very large portfolio. A good bond fund gives you instant diversification and professional management. That's asset number 3, investment-grade bonds. Your stabilizer, your shock absorber, your dry powder for when markets crash. But there's one more asset you need, an asset that most people completely overlook, an asset that provides diversification, income, and inflation protection all in one, an asset that's been quietly building wealth for centuries: real estate. Assets for real estate investment trusts, REITs. You know, when I started in banking in the early 1980s, real estate investing was for the wealthy. You needed hundreds of thousands of dollars to buy property. You needed to deal with tenants, maintenance, property taxes, all the headaches of being a landlord. But then something changed. REITs became widely available, real estate investment trusts, and suddenly ordinary people could own pieces of office buildings, apartment complexes, shopping malls, data centers, without any of the hassles of direct ownership. And here's what I've learned about REITs over the past 40 years. They're one of the best assets for retirement, period. Let me tell you why. First, income. REITs are required by law to pay out at least 90% of their taxable income as dividends. So they generate high yields, typically 3% to 5% or more. That's real income you can live on. Second, inflation protection. Real estate rents tend to go up with inflation. When prices rise, landlords can charge more. And when rents go up, REIT dividends go up. So you're protected against inflation eating away your purchasing power. Third, diversification. Real estate doesn't move in lockstep with stocks or bonds. It has its own cycle. So adding REITs to your portfolio reduces overall volatility and improves risk-adjusted returns. And fourth, growth potential. Over the long term, real estate appreciates, population grows, demand for property increases, and good REITs can compound your wealth over decades. Now, I've seen the real estate market from every angle. At JP Morgan, we finance billions of dollars in commercial real estate. We've seen booms and busts. We've seen great investments and disasters. And here's what I've learned: location, quality, and management matter. The best REITs own high-quality properties in great locations managed by experienced teams. They have strong balance sheets. They don't over-leverage. They're disciplined about acquisitions, and they focus on sectors with long-term demand. So, which REIT should you own? Let me give you a framework. First, diversify across property types. You want some residential REITs, some office REITs, some industrial REITs, some healthcare REITs. Different property types perform well at different times in the economic cycle. Second, focus on quality. Look for REITs with occupancy rates above 90%. Look for strong tenants. Look for properties in prime locations. You want Class A properties, not Class C. Third, check the balance sheet. What's the debt to equity ratio? What's the interest coverage ratio? Can this REIT survive a recession? You want REITs with manageable debt and plenty of liquidity. Fourth, look at management. Who's running this REIT? What's their track record? Have they been through a full cycle? Do they make smart capital allocation decisions? And fifth, consider the dividend. Is it sustainable? Is it growing? What's the payout ratio? You want REITs that can maintain and grow their dividends over time. Now, let me tell you about something I've been watching closely. The rise of data center REITs. You know why? Because of artificial intelligence, cloud computing, digital transformation. The demand for data centers is exploding. And data center REITs are some of the best performing assets in the market. At JP Morgan, we finance data centers all over the world. And I can tell you the demand is insane. Every major tech company is building more data centers. Every business is moving to the cloud. And that trend is going to continue for decades. So if you're investing in REITs today, make sure you have some exposure to data centers. This is one of the mega trends of our time. But let me also warn you about something. Not all REITs are good investments. Some are over-leveraged, some own poor quality properties, some are run by inexperienced management teams. You need to do your homework. You need to understand what you're buying. During the financial crisis, some REITs got absolutely crushed. They had taken on too much debt. They owned properties that nobody wanted. And when the crash came, they couldn't refinance their debt. They went bankrupt. Shareholders got wiped out. But the best REITs, they survived. They came out stronger. They took advantage of the crisis to buy properties at distressed prices, and their shareholders made fortunes over the next decade. That's the difference between quality and garbage. Quality survives, quality thrives, garbage dies. So here's my recommendation for REITs. Allocate 10% to 15% of your portfolio to a diversified mix of high quality. You can do this through individual REITs if you want to be hands-on, or you can use a REIT index fund or ETF for instant diversification. And be patient. Real estate is a long-term asset. You're not going to get rich quick, but over 20 or 30 years, REITs can be a core part of a wealthy retirement. Let me give you some numbers. Over the past 30 years, REITs have returned about 9% to 10% annually. That's close to what stocks have returned. But with lower volatility and higher income, that's a powerful combination for retirees. So imagine you invest $100,000 in a diversified REIT portfolio at age 55, over 30 years at 9% annual returns. That grows to about $1.3 million. And along the way, you're collecting dividends of 4% per year. That's $4,000 in the first year, growing to $50,000 plus in year 30. That's the power of REITs. That's why they're one of the 4 essential assets for retirement, bringing it all together. So let me recap everything for you, because these 4 assets, they're not random. They're not just a list. They work together as a system. Each one serves a specific purpose. Each one protects you against a specific risk. Asset hash 1, FDIC insured savings and short-term treasuries. This is your foundation, your liquidity, your emergency fund, 1 to 2 years of living expenses. Protection against needing to sell assets at the worst possible time. Asset hash 2, dividend-paying stocks. This is your growth engine, your inflation protection, your long-term wealth builder, 40% to 50% of your portfolio. High-quality companies with strong balance sheets and consistent dividend growth. Asset hash 3, investment-grade bonds. This is your stabilizer, your shock absorber, your dry powder, 30% to 40% of your portfolio. High-quality bonds with 3 to 7 year maturities, protection against stock market volatility. Asset hash 4, real estate investment trust. This is your diversification, your income generator, your inflation hedge, 10% to 15% of your portfolio, high quality REITs in diversified property types. Add it all up. That's 100% of your portfolio. And it's designed to do one thing, give you a retirement that lasts, a retirement where you don't run out of money, where you don't have to panic during crashes, where you can live with dignity and security. Now, I know what some of you are thinking. Jamie, this is too conservative. I want higher returns. I want to take more risk. And look, if you're young, if you're in your 30s or 40s, fine. Take more risk, be aggressive. You've got time. But if you're 55, 60, 65, approaching retirement or already retired, you can't afford to gamble. You can't afford to lose 50% of your portfolio and hope it recovers. You might not have time for it to recover. That's why this 4-asset approach works. It's not about maximizing returns. It's about maximizing security. It's about making sure you can sleep at night knowing that no matter what happens, recession, inflation, market crash, whatever, you're going to be okay. And let me tell you something I've learned over 40 years in banking. The people who retire successfully, who retire happily, they're not the ones who took the most risk. They're not the ones who swung for home runs. They're the ones who followed a disciplined strategy, who stayed the course, who didn't panic. At JP Morgan, we manage retirement portfolios for some of the wealthiest people in the world, billionaires, CEOs, celebrities. And you know what? The strategies we use for them are exactly what I just told you. High quality assets, diversification, discipline, time-tested principles that work in every market environment. You don't need to be rich to retire well. You just need to be smart. You need to own the right assets. You need to stay disciplined, and you need to start now, because time is the one thing you can't buy back. Every year you wait is a year of compounding you're giving up. Every year you wait is a year closer to retirement with less time to recover from mistakes. So here's my challenge to you. Look at your portfolio today, right now. How much do you have in these four assets? Are you diversified? Are you protected? Are you prepared for the next crisis? If not, make a plan. Start moving toward this allocation. It doesn't have to happen overnight. You can transition gradually, but start. Take action, because retirement is coming whether you're ready or not. And when it comes, you want to be prepared. You want to have options. You want to have security. That's what these four assets give you. That's why they're not optional. That's why you must own them. I've spent my entire career helping people navigate financial crises, build wealth, and retire with dignity. And I'm telling you, this works. These four assets are your foundation, your protection, your path to a secure retirement. Don't wait, don't gamble, don't hope for the best. Build your portfolio the right way, own these four assets, and give yourself the retirement you deserve. Thank you for your time. Now go make it happen.